Jamaica is a highly prospective target area for different kinds of deposits in an island arc terrain.
As probably the most widespread, intensive, and in-depth exploration program that's ever been carried out in this island.
5 or 6 years worth of work into just 2.
No one else has ever done this before. There has been historic work on the island, trending back 150 years.
I think they're getting excited, as we are, so stay tuned.
Hello, this is Andrew Thake from Mines and Money. Founded in 2006, Pacific Road is a mining-focused investment manager headquartered out of Sydney, Australia. As Managing Director of Pacific Road, today's guest, Matt Fifield, has led Pacific Road using a concentrated value investment style, focusing on active ownership and forging an expansive vision of responsible investment in natural resources. Today, I'm talking to Matt about geopolitics and its impact on the mining and supply chain. Matt, as an investor, what are the top sort of 3 geopolitical trends that you're looking at the moment?
Okay, well, first of all, Andrew, I wanted to say thanks for having me on Mines and Money Online Connect, and thank you for the people listening in. Geopolitics is very topical right now in the metals and mining sector, and there are 3 very obvious sources of tension in the world that are playing out. One is supply chain resilience. The second is carbon and energy transition. And the third would be the nature of future stimulus. And they're interconnected. If there's one parting thought or one key takeaway for people listening in right now, it's that with carbon, energy transition, and government-directed stimulus forcing growth down certain avenues, right now the metals and mining sector is becoming energy. So if metals are energy is exceedingly political. And what you're seeing is a two-way street of governments trying to figure out how do we support change in a direction from programmatic, everything from people, how do we train more geologists, how do we have more exploration, how do we have development, how do we grow markets and supply chains that don't exist today? And you have this huge push that is coming from a policy standpoint. And then, of course, if you work inside the metals and mining space, as we all do, you understand how supply constrained it is. It's very supply constrained. It is hard to ask for 3 times the amount of copper or 5 times the amount of anything, and not have a lot of volatility and a lot of questions around how is that actually going to happen. So that ultimately where it becomes geopolitical is if you think about the amount of stimulus that was just spent, staggering amounts here in Australia, 14% of GDP and 5% estimates of 5% of global GDP being spent in new money printing and stimulus. So when you print a lot of money, you're doing it to help your constituents and industry and economy survive through the rough patch. And what you would like to see ideally is that excess printing or subsidies or future influence from the government is going to influence and help your constituents and your economy. And particularly with if you think about in 2019, some of the tariff stances between the US and China, and now things have actually really accentuated where, great, we just spent trillions of dollars. Let's make sure that those economies, that money stays in our economy or that of our close associates. So what you're seeing is a separation of the world geopolitically into kind of the jets and the sharks from a West Side Story type of a way, where when you're a jet all the time. So if you're in the US trade bloc, the discussions at the political levels are really about how do we support each other, US, Canada, Australia, on and China as well. And so that's pretty natural. One of the things that I think is very interesting, I'll come back to the themes of energy transition, batteries, cars, and energy and metals being energy, is that Europe has really emerged as a separate block unto itself, which is or trying to where Europe is really driving towards. We want to know where our energy transition materials are coming from and how that's all going to shake out. So geopolitical, so let's go back and summarize, clearly metals is energy. And that's something that is much more front and center in people's minds than it's ever been before. The second is with government's hands in the economy and direct stimulus past and future, there's a lot more geopolitical content and jets versus sharks in terms of how the world is evolving. And then the third is there's this overarching piece around carbon and decarbonization that is impacting the whole.
And then taking some of those key sort of like supply chain initiatives that are going on, things such as the EU supply chain initiatives that you briefly touched on, things such as Silk Road, I guess the US 43 Critical Minerals Directive. How will that sort of impact the mining industry? What does it mean for some of the miners who are listening in on this interview?
Well, it's one of the things to me that I find very interesting is that policymakers can enact policy, and sometimes the policy from a tax or tariff standpoint have very real outcomes. But other times you're enacting prospective policy where I would like for this to happen. So we at Pacific Road, we very carefully have followed over the last 7-8 years. It's been a long-standing progression around how do we deal with critical minerals, or how does the United States deal with critical minerals? And it goes all the way back to Reagan, but Obama was working on it, and obviously Trump was working on it, and now Biden is working on it again. So these different national or supranational directives that are coming together are interesting, Andrew. But governments regulate and legislate, and it's the private sector that enacts. And so, I think that's probably, I don't know how to underscore the importance of that. The future that I see is whether it's direct or soft stimulus, where you have governments creating legislation. I want something to happen. What I think will happen is national champions will be able to get all sorts of cookies or goodies from, logically from governments to support a build out in a direction. So let me give you an example. I think it's entirely logical that the auto manufacturers who are pushing increasingly for complete electric vehicle transition, in order to build factories that are going to employ a lot of people, and in order to build supply chains that are going to, put the batteries and car frames together that are going to employ a lot of people, in order to induce consumers to buy these electric vehicles, that in almost each step of that, you'll see these general directives become very specific in terms of how it influences. You'll see government subsidies for loans to buy electric vehicles. You'll see state, local, and federal subsidies to build production to de-risk supply chain and create jobs and move in that direction. So the directives themselves are interesting because what they're saying is, private sector, we want to go over here. We want to be over here, but it's really it's in this next 2 to 5 years where this is going to be shaking out. And so it creates tremendous challenge and tremendous opportunity for the raw material supply chain of almost everything to get involved.
Mm-hmm. You obviously just briefly touched on the US end, and obviously one thing that's obviously happened over the last few months, we've had a Biden presidency. How has that impacted the US-China sort of trade commodities war? And I guess the sort of follow-on question from that is, how significant, in your view, is the US rejoining the Paris Climate Agreements?
Interesting. Okay, great question. So, in the Biden presidency is off to a very continuous start, hawkish on China. One of the very first executive orders out of the White House was around critical minerals, and there is an increasing news flow. There is increasing engagement with investors and private sector participants to de-risk supply chain. And de-risk supply chain is kind of code for don't have it all run through China. Now let's just step back for a second and be realistic. What you don't need is 100% of control over your supply chain. And so I don't predict that that's an outcome that happens in anything. But what I do think you'll see is some domestic capacity being built in the US, or some domestic capacity being built in Europe, or in the Chinese in their push for broadening out their iron ore supply, for example, some additional sources of iron ore supply, so that everybody can kind of look at each other and say, number one, job well done. Number two, we don't really need you. See, we can go do this. But the world will still remain interconnected at the core of it. There's just going to be a push to build some amount of supply chain resilience, so you're not left totally out of skills, of material access, and critical things. There may be parts of the supply chain that become wholly duplicated, and those will have most likely military aspects to them. But so the first is is going to be around the supply chain resilience that people are building in. The second, in terms of carbon, so if you think about carbon is so interesting because it's very clear from a consumer mandate and a voter mandate that it's an issue that people are paying attention to as ESG investors look at how do I quantify things. Carbon is very easy to quantify, or it's hard to quantify human rights. It's easier to quantify your tier 1, tier 2, tier 3 emissions. And so because it is quantifiable, it's measurable. Because it's measurable, you can improve upon it. So I would say that in general, carbon measurement and abatement, it's just an unstoppable trend, right? So that's the first. The second is that I think it's very savvy on a political basis for the U.S. to rejoin the Paris Treaty, because you have to be a part of what's going on in order to influence and get what you want. The complexity of the U.S. rejoining after having disappeared is real, and so there'll be continued news flow and change around that. But despite that short and medium term noise about what does it mean to catch up and be a part of it, what you're seeing is a United States that's more engaged in the traditional power coalitions and will be participating and in a very active way, unlike the prior administration.
Mm-hmm. You're obviously based in Australia, and Australian-China trade relations suffered in 2020, I guess specifically when Australia asked for an inquiry into COVID-19. How is currently the relationship between Australia and China, and I guess specifically what does that mean for the mining industry?
Mm-hmm. Look, I'm gonna duck a lot of that question, but what I would say is that at the heart of it, it's Australia has a challenging position because its major economic partner and consumer of export goods is China, and realistically that's very difficult to change. So it's almost impossible to change, perhaps generationally, and at the same time, its political and military alliances are elsewhere. So Australia sits in an uneasy position where it's kind of the hinge between two big, heavy doors. And what we're seeing right now, for example, in the coking coal space, is extreme volatility, fisheries, agriculture, and I think that you'll continue. The one thing that I think you can expect is that it will continue to be a difficult position to occupy. The second is that it will be occupied courageously, and then the third is that it'll continue to be volatile.
Mm-hmm. So at Pacific Road, how do you factor in geopolitical risk when making an investment? Can you please give us a few sort of like guidelines as to what your how you build it into your investments?
Mm-hmm. Yep. So I would say we look at country risk profiles. Look, there's a whole host of things when you get into making a specific investment that would probably be like a lot of other concentrated investors, which is that you want to understand the landscape, you want to understand regime change. Are there elections coming up? You want to understand fiscal strength. Are you and we will use everything from these days, from the Fraser Index through to Moody's and sovereign risk, as different ways to try to get a gauge on how that is. What I will say is, at the moment, we're in terms of taking geographic risk with we're pretty shy at the moment on taking geographic risk, and that's probably a measure of the fact that we're seeing enough opportunity out of lower geopolitical risk areas that we, so at the moment it's an extraordinary investment profile at the moment that is bringing us to Africa. And we are finding select, top 5 mining jurisdictions. We're still finding a lot of interesting things to do. And some of that comes back to thoughts around exit and liquidity, not necessarily just around risk, because risk is present everywhere. The resource industry is full of risk, and you try to manage that risk. And some jurisdictions have less containable risks than others. But as we look towards new investments, what we think at the moment is the supply side constraints in the mining industry will cause people to look for growth projects. And the first thing they'll do is look at the very best growth projects in lower risk jurisdictions, and then look at the very best growth prospects in higher risk jurisdictions. So while we, as a firm, are deeply involved in Africa across a number of investments, or in some higher risk jurisdictions, at the moment the opportunity set is filling the bucket in lower risk jurisdictions first.
Sure. And I guess I was trying to sort of then interlink geopolitics and ESG, which I know seem really, really important to Pacific Road. What is that sort of like interrelationship between geopolitics and ESG?
So let's go back, because this is probably one of the most important things that we're talking to management teams and that we discuss with other investors about. So go back to the place where you have government blocks trying to create a direction and supporting national champions and domestic production, all the rest. You have to be in that game, and ultimately the consumer wins. So if you want to appeal, the forward vision that I see, for example, in battery minerals, is very similar to the coke and coal markets across the world, where you'll see car companies owning direct stakes in mining companies so that they can ensure that they have the materials to build the cars that they want to build, to qualify for low cost funding, to enact the whole game plan. And you see that a lot of the time in the steel chain, iron ore properties will have end users involved. Coke and coal properties will have end users involved. And what you're going to see is that's just going to continue to replicate itself. So step back for a second. And by the way, I'm pretty sure that that's correct. And you've seen some signs around at Tesla, with Goro and all the rest. But that is only going to accelerate. So stop for a moment and think about what makes a more interesting, investment. One where somebody's across all the material risks, making public disclosures about how it's working, is managing some of their stakeholder risks in a very proactive way, and has good pounds in the ground and good mining mining prospects, or one that doesn't. And what you'll find is that you'll have different sets of partners that are really going to key into those ESG aspects. So if you want to appeal to, again, thinking here more about auto manufacturers, but if you want to appeal to Western consumer product manufacturers like car companies or computer companies or anything else in this kind of tech revolution, or even upstream into PV and wind and solar, you're going to see differentiation between producers that are able to articulate how they are on carbon emissions. That's going to be important. Human rights, corruption, and you've seen this whole thing start in its infancy. If you go and look at how Apple and LG and some of the other consumer product people look at their sort of gold and tantalum and tin and all the rest, it's just going to extend itself into the rest of the metal supply chain. So to bring that back, Andrew, what that means is be front-footed and be thoughtful about it. And if you are, your strategic options, and therefore the paths to prosperity for investors, will open up. And if you're not front-footed about that, and you're confused about it, you'll find that the number of people that will be supplying you low-risk capital to develop, to grow, to build and expand and acquire will shut down. So it's huge. And so whether you call it geopolitics or you call it the shape of the world to come,
Okay.
which is, to me, it's very intertwined.
And just one final, just kind of quick question. Have you read any recent book on geopolitics that you would recommend to any of our listeners?
That's an interesting question. Look, I just reread Silk Road again, both volumes of that. And what I like about it is it challenges my perspective, which naturally, by my accent and location, is a very Western perspective. And I just I like the first and second volume of that, and it's good to challenge your perspective sometimes because you can get too focused on knowing what you know and not interested enough in the world around you.
Thank you very, very much for that. I think we've just run out of time. So this is Andrew Thake from Minds and Money and Matt Fifield, Managing Partner of Pacific Road Capital.
Thank you, Andrew.
Thank you.